If you are currently trying to buy a house, look at your bank account without crying, or wonder why rent keeps climbing, you've probably blamed your boss, your landlord, or the Federal Reserve. But there is a different system pulling the strings. It is an invisible, $145 trillion machine called the bond market. It dictates the price of your future house, your car loan, and whether your future employer has the budget to hire you. Let's take a regular guy named Brian. He's trying to buy an average $400,000 home with a standard mortgage. When the bond market has a single trading week where yields shift up by just 1 percentage point, Brian is handed a massive hidden penalty. That tiny macro movement costs him an extra $96,769 in interest over the life of his loan. To understand why Brian's monthly payment shifted so drastically, we have to look past the local bank and see exactly how this $145 trillion market actually functions. Most people assume bonds are just boring paperwork for grandparents, but they are actually very simple. A bond is a formalized loan between a massive entity, like a government or a corporation, and an everyday investor. You hand over a lump sum of money, called the principal. In exchange, the borrower signs a digital contract promising two things. They will pay you a fixed reward fee every year, called a coupon, and they will give your original money back on an exact deadline, called the maturity date. A bond is a legally binding promise to pay rent on borrowed cash. That is the entire instrument. The benchmark for this entire system is the 10-year U.S. Treasury bond. It currently pays a fixed yield of 4.5%, which serves as the baseline cost of money for the planet. When a commercial bank decides what to charge you for a mortgage, they look directly at that 4.5% yield. They ask themselves, why would we take a risk on a regular human who might lose their job when we could lend money to the government risk-free for the same return? This chart shows the literal math they use to solve that problem. Banks take that treasury yield and stack a standard 2% risk markup on top of it. That is why the national average mortgage rate sits right around 6.5%. This market operates like a perfectly balanced seesaw. When interest rates in the broader economy rise, the price of old existing bonds crashes. When rates fall, bond prices shoot up. Because of this relationship, a 1% shift in the macro market moves the baseline. The bank's markup shifts in lockstep, and Brian's mortgage rate reaches 7.52%. Brian's monthly financial survival isn't determined by his credit score alone. His future is mathematically tethered to the shifting price of global government debt. The 10-year Treasury yield serves as a primary indicator for your future borrowing costs. When it climbs, your future mortgage and car loans get more expensive. But if this bond market has the power to dictate exactly what you pay, it should also dictate what you earn. This comparison shows the gap. The average traditional bank savings account in America pays a 0.38% interest rate. Meanwhile, a 3-month U.S. Treasury bill pays 3.71%, nearly 10 times as much earnings on the exact same principal. Both options carry the same level of institutional safety, backed either by federal FDIC insurance or the U.S. Treasury. If Brian leaves $50,000 in a traditional bank account instead of shifting to Treasury bills, he loses out on thousands of dollars in interest over a few years. It is money he is effectively handing back to the bank. The people who dominate global finance aren't inherently smarter. They just stopped pretending this machinery was too boring to understand. Now you can do the same.